In the quiet, snow-covered town of Farmington, Connecticut, there stands a company that seems to defy financial gravity. Every month, without fail, it delivers dividends to its investors, rain or shine. The company's name is Horizon Technology Finance Corporation, traded on the NASDAQ under the ticker HRZN. To the casual investor, Horizon appears to be the epitome of stability, a steady monthly payer in a volatile market. It has earned nicknames like the Island of Dividends and the Dividend Machine. But for those who have examined its financial statements closely, something doesn't quite add up. Horizon's net income has been consistently negative, yet its dividends continue to flow as if nothing were wrong. In the world of finance, that is deeply abnormal. Ordinarily, a company reduces or suspends dividends when profits shrink. Horizon, however, has done the opposite, maintaining its payout even amid losses. That contradiction is not a trivial accounting anomaly. It's a mystery, one that goes to the heart of how this business truly operates. Horizon Technology Finance is not a traditional bank. It is a business development company, BDC, a specialized investment firm designed to finance growth stage and venture-backed companies that can't yet access conventional credit markets. Unlike banks that lend against tangible collateral like property or equipment, BDCs often lend against future potential, the intellectual property, patents, and technological promise of startups. In return for assuming such risk, Horizon not only earns interest income, but also receives warrants, which give it the right to buy equity at a fixed price if a borrower succeeds or goes public. In short, it's a hybrid model, part lender, part venture capitalist, high risk, high reward, and dependent on the volatile frontier of innovation. The company's focus industries, technology, life sciences, healthcare, and sustainable energy all have something in common: enormous upside, but equally enormous uncertainty. Traditional banks avoid these sectors precisely because their borrowers burn cash, pivot business models, and sometimes collapse entirely. Yet Horizon embraced that volatility as its business model, and for a time, it seemed to work. Its loan portfolio produced average annual yields around 18%, far higher than what most banks could dream of. But strangely, those yields didn't translate into profits. Despite high interest returns, Horizon's net income kept declining. That defied every rule of corporate finance. When revenue increases, profit should too, unless hidden losses or rising costs are silently eroding returns. The first major inflection point came on July 5, 2023, when Horizon's external advisor, Horizon Technology Finance Management LLC, was acquired by Monroe Capital, a major Chicago-based private investment firm. Under normal circumstances, such an acquisition would be a bullish signal: stronger funding pipelines, broader institutional backing, greater economies of scale. Yet the opposite occurred. Post-acquisition, Horizon's balance sheet became more complex. Intercompany flows multiplied, more subsidiaries appeared, and capital began circulating in ways that became increasingly difficult to track. Though capital inflows rose, profits continued to fall. It was a complete inversion of financial logic. Typically, restructuring improves efficiency. For Horizon, it appeared to magnify inefficiency, or perhaps conceal it. And that's when investors began asking the question that still haunts the stock today: where is Horizon's dividend really coming from? In the summer of 2024, that question deepened. Horizon announced that its subsidiary, Horizon Funding II, had received approval to issue between $100 million and $200 million in corporate notes, essentially new debt instruments. Normally, companies issue notes to fund expansion, acquisitions, or new product development. But Horizon's timing was curious. Its profitability was declining, yet it was increasing leverage. Around the same time, it renegotiated its credit facility with KeyBank, extending its maturity and boosting its borrowing capacity. It also sold roughly $3 million in new equity shares through an at-the-market program. Multiple capital sources were being tapped simultaneously. And when analysts traced the destination of those funds, one conclusion stood out. Much of that fresh capital wasn't going into new loans or portfolio growth. It was being used to sustain the dividend. That is extraordinarily unusual. In corporate finance, dividends are supposed to be paid out of net income, the profits left after all expenses. Using borrowed money to pay dividends is, in effect, borrowing credibility from the future to preserve confidence today. If that's the case, then Horizon's dividend policy may be less a reflection of financial health and more an exercise in optics, a way to maintain investor trust and prevent a stock price collapse. On August 7th, 2025, the story took another turn. Horizon announced plans to merge with Monroe Capital Corporation, MRCC, its advisor's sister company. The official rationale was to improve scale and efficiency, reduce costs, and expand reach. But a closer look revealed that both entities shared the same structural vulnerabilities: high leverage, large dividend obligations, and overlapping portfolios. Merging such balance sheets doesn't diversify risk, it compounds it. Nevertheless, the merger was approved. On the same day, Horizon reaffirmed its monthly dividend of $1.11 per share through the fourth quarter of 2025. The market initially applauded, but beneath that applause, the red flags multiplied. Then came October 28, 2025. Horizon released its third quarter earnings. Net investment income came in at 32 cents per share, net asset value stood at $7.01 per share, and its loan backlog reached approximately $110 million. Yet once again, net income remained negative. And still, the company declared it would continue paying dividends through the first quarter of 2026. To most analysts, that decision defied economic reason. Ordinarily, a firm facing recurring losses would preserve cash, retain earnings, and shore up liquidity. Horizon, by contrast, doubled down on payouts. The only logical inference: the company's dividend funding source had shifted from earnings to debt. The mechanics of that debt-driven dividend are now clearer. Horizon's web of subsidiaries appears to recycle capital internally. Horizon Funding II issues notes. The proceeds flow up to the parent, and those funds are then used for both new lending and a dividend distribution. Technically, it's legal. Substantively, it's financial recursion, a loop where borrowed capital sustains investor expectations. In the short term, this illusion works. In the long term, it creates a ticking clock. Rising interest costs eat into returns, and as leverage increases, so does fragility. What looks like stability today could, under stress, unravel quickly. As of now, Horizon Technology Finance trades around $6 per share, with a dividend yield north of 20%. To uninformed investors, that yield may look like opportunity. To those who understand the math, it looks more like a warning signal. The company's net asset value is slowly eroding, its debt structure is increasingly opaque, and the risk-adjusted sustainability of its payouts is deteriorating. In effect, Horizon may be masking structural weakness with the sheen of consistency. And yet, the illusion persists. Every month, dividends are paid on schedule. Every press release reaffirms stability. But in the silence between earnings reports, debt quietly accumulates. The calm, as every seasoned investor knows, can sometimes be the most deceptive moment of all. Horizon Technology Finance remains a symbol of contradiction, the company that pays investors not from profit, but from borrowed breath. So ask yourself, does this calm represent genuine financial discipline, or is it the silence before the storm? Also, the Valuester channel is inviting listeners to share ideas on listed, unlisted, or pre-IPO stocks and cryptocurrency projects that intrigue you. Leave your suggestions in the comments. Our team reviews them all and may feature your idea in a future in-depth investigation. To all who watch, subscribe, like, comment, and share our content across platforms, thank you. Your engagement drives our work and pushes us to deliver sharper, deeper insights every time. This was Valuester.